Hi, this is Ron from Tax Solution, and today we're diving into the world of Swiss taxation once more, where we'll be breaking down the essentials of Swiss tax residency in Switzerland, the rules for those who live abroad but work in Switzerland, and how the year of your move to Switzerland affects your taxes. We will also be discussing the difference between tax resident and non-tax resident individuals and a new concept called Quasi Residency. Let's get started. If you're a tax resident in Switzerland, you're subject to what's known as unlimited tax liability. This means that you're taxed on your worldwide income and wealth, not just what you earn or own in Switzerland. This includes your salary, any dividends you receive, interest on your bank accounts, and real estate even to some extent. You are considered a tax resident if you permanently establish your usual abode in Switzerland, where you have your center of vital interest, and you're registered with the municipal authorities. Basically, if you stay in Switzerland for at least 30 days with the intention to work, or for at least 90 days without the intention to work, you are considered a tax resident. Of course, this gets a little bit more complex in the international framework. But let's first have a look at what happens with taxation in the year of moving to Switzerland. If you move to Switzerland, usually your tax liability starts backdated to your registration date, which you can find on your permit. If you're only taxed at source without the obligation to submit a tax return, you will simply see the source tax deduction on your first salary. For tax subjects who have to file a tax return, though, the first tax return will apply only to the part of the year where you lived already in Switzerland. So if you moved to Switzerland on June 3rd, your tax return will cover your worldwide income between June 3rd and December 31st, because that's when the tax year ends, and your wealth as of December 31st as well. Your permit status, for example, B or C permit, plays a key role in how you pay your taxes. Holders of a B permit have their taxes withheld by their employer and directly paid to the tax authorities. C permit holders, on the other hand, pay their taxes, like Swiss citizens, for example, via monthly or quarterly advance payments. So if your income is above the 120,000 annual threshold, or if you have substantial wealth or secondary income sources, you will have to do a tax return even if you are taxed at source with a B permit. Check out our video about Swiss tax filings if you want to learn more about that. It is quite a common misconception that your tax liability in Switzerland only starts as of 183 days, but that rule, that is part of many double taxation treaties, does not govern when your tax residency starts. It applies to different types of cases. Your tax residency starts as soon as you have moved, in most cases. So make sure you know whether or not you have to do a tax return for your year of arrival. And in case of doubts, you can always reach out to the tax office, for example. Now let's talk about tax resident and non-tax resident individuals. Non-tax resident individuals, that is, those who aren't considered residents for tax purposes, are only taxed on Swiss sources of income and wealth. This includes income from working physically in Switzerland, income from Swiss businesses, and certain assets located in Switzerland. But what if your main residence is abroad, yet you're working and staying regularly in Switzerland? In that case, you're subject to limited tax liability in Switzerland, meaning you're only taxed on your income you earn within the country. The situation is common for commuters who work in Switzerland a few days a week, but have their private center of life abroad. For example, when their family lives there and is visited every week or every second week. In this situation, Switzerland is not considered your main tax domicile. Now, this leads us to a new concept that was introduced in 2021, quasi-residency. This term refers to individuals who have their center of life and therefore their main tax residence abroad, but their situation is similar to someone who actually just lives and works in Switzerland. And what this status of a quasi-resident does is it would allow you to file a voluntary tax return and potentially claim more deductions compared to just being taxed at source. The requirement, though, is quite strict. At least 90% of your worldwide household income has to be earned in Switzerland. in order to be considered a quasi-resident. And the tricky thing is your spouse, for example, is considered in this as well. So for most double income household, it's not applicable that only one of the spouses, the one working in Switzerland, earns at least 90% of the household income. If you don't meet this criteria, you don't have the option to file a voluntary tax return, which is quite a problem for many international commuters. So in conclusion, the first important thing to point out is that you need to know what residency status applies to you, whether or not you have to file a tax return, what your entry date in Switzerland means for your specific case, because as you saw, it can be different based on, for example, whether or not you have to file a tax return. And lastly, the point about quasi-residency, it applies more to special cases where someone has only a limited connection to Switzerland and still the main tax residence abroad. And these group of taxpayers are facing quite some hurdles because the practice of the law is not yet that established. I hope this video gave you a quick and nice overview of the different residency status, and see you in the next video.